Welcome to Trading Triumphs, the journey to success, and this is part 2 of my 3-part series with legendary total trader and trend following legend Jerry Parker. Now in part 2 of this series we're going to be talking about using excessive risk and how Jerry discovered that he was trading way too hot and what he did to overcome that, and also how we can avoid the dangers of using excessive risk. Plus he's going to share a whole lot more with us, so let's get to it. So I'd like to move on to the next point here, and that is size, or specifically trading too large. I know this is something that you've mentioned to me before, and something that can be a very costly lesson for some traders, I guess. So can you take us back to a moment where you discovered trading too large?
I think that's like it's 1 and 2. Follow your system and trade small are the best 2 lessons and ideas that you can tell people and have people absorb. And if you trade too large, it's going to impact your ability to follow your systems and follow your rules. You're going to panic, and you should panic if you're trading too large and you're losing too much money. You should panic, and you should trade smaller and reduce your risk. But that's a non-system trade. So you really don't want to do non-system trades. You may have to do them, but you prefer to do your system, your 1 entry, 1 exit, and a stop loss, maybe having multiple look back periods. So you have a couple systems, a shorter term and a longer term system. But the goal in life would be to continue just to do all those trades in the way that you should and not have to exercise any kind of extreme money management, risk reduction, position cutback idea. But it could be necessary. But I began in 1984, and we were trading way too large. So I came out of it like, this is crazy, right? This was not a way to trade we didn't have to raise money and find clients. This was a strategy and a leverage usage that he just needed to have a few $1,000s, and we were making 200% a year. So with just small amounts of money, we were really doing really well, and this is not possible now, as far as I know, is using similar ideas like trend following. But from day one, I was trading too large, and I had a 50-60% drawdown in 1 day once. So we got inoculated, but we were sort of immune to it. Rich told us what to do: follow these rules, trade this size. We just wanted to please him and do what he wanted us to do. And this is what he wanted. This is how he traded. So we didn't know any better. We didn't have much experience. We were like a clean slate. No matter what he told us, we were probably willing to do it. And for the most part, we wanted to, and we did. And so, but it didn't take me long to realize when I started Chesapeake in 1988, that trying to make 200% a year is not tenable, because we did want to build a business with clients and stable business. And so we thought, well, let's maybe try for 25 or 30%. And then I think that was probably too much for me as well. And I needed to continue to realize that I needed to trade a bit smaller to fit my kind of personality. I think choosing the amount of leverage and risk that you like, that's comfortable for you, is the one piece of kind of discretion, I think, or personality. It's the only place where I think I want my personality to influence my trading. For the most part, my personality should not influence my trading. Trading is hard. Trading is difficult. It goes against human nature. No one wants to take small losses. No one wants 10% of the trades to pay for all the profits. No one wants profits to turn into losses, big profits to turn into small profits. Everything about trend following, no one likes it. Like everybody else, I want to make 1 or 2% a month, very calm, but that's not possible. And you have to pay attention to the back test and pay attention to what works in the markets, and try to be tough. And like I just described all my mistakes initially, get over your mistakes, understand what it takes to make money in the markets. However, if your personality is you can accept a 50% drawdown and you've got a good system and money management at that level would be necessary so you would not lose all of your money and lose all of your clients, then fine. There's traders out there we know that do that. More like me, I'd rather make about 15 or 20% a year and have a 20 or 30% max drawdown. And so that's my personality. But the two traders should be trading very similarly or with the same sort of strategy. Your personality, I don't think should influence your strategy as much as it does influence your risk tolerance, let's say.
Right. Okay. So then, I mean, the example you gave then is you knew you were trading too large because of the drawdown, but that's kind of you figure it out after the fact. How do you know you're trading too large before you hit that drawdown? Are there some clues or some factors that you need to consider that could show you're trading too hot?
Yeah, I think one of the most important ones is that can you mentally continue to follow the system?
Right.
If you have, that's number one. If you can't mentally, you're so stressed out, you can't follow the system, maybe trading is not for you. I mean, that always needs to be on the table. And all the podcasts I've done, I've never talked about that, or people have never asked me about that or brought that subject up. It was definitely one of the first things Rich talked about, which was maybe trading is not for you. We just have to face that. It may not be for everyone. And doing these, putting yourself in a situation where you're required to follow these very difficult rules is maybe something, that people don't want to do. They can't do it. Yeah.
So what then? I think this is an interesting topic. What type of people do you think trading isn't for?
Well, I think it's definitely not for people who like to gamble and like to trade too large. People that have a resistance to rules and systems. Some people I've met over the years, they feel like if they had to trade a set of rules that were back tested and be beholden to this computer telling them what to do, that would take the fun out of it. And they honestly convince themselves that they have some sort of talent discretion-wise. I think any kind of talent I might have or experience I might have would be made up for by me just following the system and doing the trades exactly the way that I'm supposed to do them. And I wouldn't really lose too much. I'd probably be right about half the time. And then who knows what would happen. I could maybe just devolve into someone who no longer wants to really follow the systems. It's like taking swearing off alcohol and taking that one drink. Who knows? You may give up on your systematic approach. So I think you should probably be careful not to do that.
Yeah, right. And so what about if you're a trader and you've done the gut check as you've mentioned, and emotionally it's very hard to take these trades and potentially you're trading too large. What should those traders do? Should they just cut back, or is there some other options for them?
Well, I think the second point I wanted to mention was nothing is more important in systematic trading than doing all the trades. And in order to do all the trades, you need to not be in a situation where you may have to override your system in some sort of way to where you're going to have to not take the next trade, or at least not do it in the way that you've been doing all the trades. Reduce your risk, reduce your position size. And this is good, proper money management to stay in the game and to survive the markets. And I think that if this happens to you, so you just pick a point where I think a 30% or 20% drawdown is where I'm going to start reducing my positions and my future trade size. Eventually, when I get back to making money and I get out of this drawdown, I'll go back to trading my normal size or a size that's a bit larger. But these are non-system trades. I know CTAs want to talk about their core system and their money management system, and as if it's one thing. But I don't agree with that. You have your core system, your one entry, one exit, a stop loss. And then if you have to use this oppressive overlay of money management and risk control on a daily or weekly basis, you're no longer doing the system. You back tested this system. The computer did all those trades, and now you're coming along with too much leverage, or and frequently having to reduce your positions, then put them back on, and now it's just become a complete mess. And so this type of cutback is what we used to call a cutback rule. We were doing it all the time because we were over trading. Now I do it almost never because I've set my system up with my leverage, my trade level calculation, my systems, the size of my stop loss, the win percentage of my systems, to where and my leverage, to where I never really get in these situations. You don't want to get into a bad situation. I listened to a pilot the other day. Someone was describing to him a bad situation where someone crashed in a plane, and they asked this expert, what do they teach you in school, or what do they teach you to do when you get into those situations? And his response was, they teach you not to get into those situations. So sometimes you get into situations and there's no getting out. This happens in every part of life, and so that's the trader wants to have that mentality. This frequent application of adding and subtracting positions is really a bad idea.
Yeah. What type of situations do you think it might be acceptable to consider overriding a system?
I think I've had some situations like that where I've just come in and said, let's go flat. Let's go flat, half our positions. I think excessive volatility, crazy volatility, massive drawdown, COVID, let's reduce. Things are not normal here. Let's wait for things to calm down. A general like drawdown, your drawdown, as I mentioned earlier, I personally can go years and years and not have a bad drawdown. And then when you do have it, you can't control it. And it's just one of these crazy events that occurs. Then, you didn't do anything wrong. You just can't trade so small that you're never going to have a situation like that. If you trade that small, then you might as well not trade. So sometimes you just have to come in and say, hey, let's just be extreme and reduce risk and wait till the volatility settles down. I think volatility should be kind of ignored by trend followers, especially on an individual trade. And because we're supposed to let the profits run, and part of what makes these profits so large is the volatility increases, and it gets a little scary. So I will lose, 3 or 4 ATRs on a trade, like a really small little trade, a really small loss, only risking 3 or 4 ATRs. But if that trade gets going and it's a big profit, I may risk, 10 or 20 or 30 ATRs because it may be a 500 ATR trade. I've seen that. Eli Lilly is a 500 ATR trade, and it had a 50 ATR drawdown a few months ago. And then it started just going back again and making, the trend continued. So this is what trend followers do. They have this one mentality as relates to losses. They're going to be small. If it's then we turn into another totally different type of a person when it's a profit. By the mere fact it's a profit, we're going to sit there and absorb a lot of volatility. But I think sometimes, back to your question, this volatility in every market, it can get so destabilizing and so crazy that's probably good. It's probably a good money manager move to dramatically reduce your portfolio and wait for things to calm down. The great financial crisis, possibly. Although sometimes when markets are really devastating for traditional assets, CTAs are short, making a ton of money. So I would not touch a trade that's really profitable. The S&P hit a 200-day low in January 2008. So that was an easy one for the CTAs to get short way before the financial crisis showed itself and hang on to those great positions, which I think most of the people did. And that was a great year for CTA trend following.
Yeah. So those situations you just mentioned, were they are they things that you've thought of ahead of time? Like, if this kind of thing happens, then I'll consider doing this, or is it just when it happens, you draw on all your years of experience to figure out how to manage that?
I think it's better to have a rule, and that's based upon losing money primarily, this drawdown, and use that cutback rule, which is to reduce your positions by 20, 30, 40, 50%, whatever you think is going to be sufficient. It's the best rule ever. It is the greatest rule. It's the one rule that will keep you alive. Don't get too fancy with your money management. I like to have nothing going on except I'm tremendously diversified. I have on longs and shorts. I'm taking small losses. Then that's my money management, all wrapped up inside of my trend following. I'm letting profits run to pay for those losses. However, every now and then I want to have this one brutal rule that says cut back across the board material amount of your positions so you can preserve your capital and put them back on later when things kind of settle down. But I want that to be something I have to invoke very infrequently.
Yeah.
Because before I even start trading, I have all of these great money management ideas already embedded in my trading.
Yeah.
I don't want to get there, overtrade, not have good rules, and say to myself, well, I'll figure it out on the fly. That's going to be a little bit of disaster possibly.
Yeah. I really like what you said there, Jerry. One rule to keep you alive. It's the one rule to keep you alive. That's how important it is.
Yep.
Okay. So thank you very much for you wrapped that little moment up quite nicely as well. So thank you very much for that. Okay, that's the end of part 2 in my 3-part discussion with Jerry Parker. In part 3, we're going to be talking about optimization. Jerry's going to share a story about how he used optimization and the unexpected impacts it had on his trading results. Plus, we're going to be talking about how to avoid over-optimization and a whole bunch of other trading stuff as well. So make sure you catch part 3.